Hello and welcome everyone to another episode of the Investing with IBD Podcast. It's Justin Nielsen, your host, and I'm joining you from a different background. For those of you that didn't get the memo, I am doing construction upstairs. We're doing a little remodel. After a few years of not having a bedroom, I'm going to actually have a bedroom for a little while. So we're doing that, and I've moved into my daughter's room. A lot of people said, "Hey, it's supposed to be the other way around, where the kids move back in," but I'm moving into my daughter's room. So I've got a nice little different background for you all. And we're coming to you on August 6th, 2025. So we'll see how long this construction lasts and how long I have the background. But yeah, something new, something different. And, construction is stressful enough, and the market doing what it's doing with the turbulence, and who better to go through it than David Keller from Sierra Alpha Research? I need a little fun in my life, and there's no one better than David to bring that to the table. David and I always have a good time when you're on. So welcome back to the show, David.
Good to see you, Justin. Congrats on the new background. Looks very good.
Yeah. Okay. Some people were saying, on a different show, that it made me look younger. Which, in that case, I'm just gonna keep on tweaking my lights until everything looks good. So, David, gosh, this market. Okay, we're still in the throes of earnings season. I mean, we've got a lot of them behind us,
Yeah.
and we've got some of these big gainers. I mean, like, forget your 5%. That's chump change. 10%, 20% gains on some of these earnings announcements. Last week we had kind of a rough end to the week. So I guess, a few weeks ago, it felt like this lockout rally that people were saying, oh, you've got the fear of missing out, and how do I get in when, everything looks extended and everything. And then, of course, we were talking about, is there another acronym? Is it a FOLE? I like how you put a little accent to it. A fear of losing everything when you have a day like Friday and you
Yeah.
take this big hit. So how do you kind of manage your emotions during a time of market turbulence like this? And again,
Yeah.
it is emotional, right? When you're trying to
It
get on the
for
right
sure.
side of things.
For sure. And I think it's very easy to become complacent in a bull market phase when it feels like everything's kind of working. It feels like things are very easy. It feels
Hmm.
like good stocks are getting better. And that's all good. That's all encouraging. But I think what we saw at the end of last week is that it doesn't take much for the market to all of a sudden feel very jittery, right? Friday felt uncomfortable. And I would say for a lot of investors, as you alluded to, Justin, it's an emotional reaction. It's not
Yeah.
a rational evaluation of changing evidence. It is a visceral, a physical reaction, a psychological reaction to the fact that things actually, don't go up forever. There's going to be some sort of pullback involved. So, I mean, to your question, how do you sort of manage it? I mean, I think for me, it's really important to think in terms of multiple time frames and try to separate short-term noise, right? Sort of the
Hmm.
normal fluctuations you're going to have in a market versus something that's more of a cyclical rotation, something that really tells you there's something different happening. And then there's that third category, which is something really climactically bad, right? Sort of that doomsday scenario. But I
Right.
think to your point, right, FOMO has been the story off of the April lows, particularly in technology, the AI space, which has been, remarkable strength off of the lows. But it shows you, I think, at the end of last week, how quickly that those stocks that have had incredible runs, you see the reality that they could actually turn lower at some point.
Yeah. And I mean, everyone knows that intellectually, but again, sometimes it can still come as a surprise, like, oh well, I wasn't expecting it to happen now, type thing.
Yeah,
So
yeah.
yeah, it can be challenging. Now, one of the things I also wanted to discuss. I mean, you're a CMT. I should have added those such important letters behind your name as I introduced you, which of course means Chartered Market Technician. And there's a lot of economic stuff. I mean, we've been, you know, f-
Hmm.
looking at headlines from tariffs to the Fed. What's going on there. Will they cut? We had two dissenting votes by governors this last Fed meeting, and it seemed like it was this last jobs report, of course, that we got on Friday, opening the door to a cut on in September. So, how much do you rely on kind of that macroeconomic side of things, what's happening with the economy and these reports, versus just, again, you're a market technician looking at the technical action.
Yeah. No, it's a really good question, Justin. I mean, the big picture answer, and then I'll talk specifically about the conditions I'm sort of seeing here. But I think at a high level, I think of four main pillars to your investment process. And to Bill O'Neill's credit, I think he brilliantly sort of demonstrated that through Investors Business Daily and all the tools you have available. But I would say it's four pieces. It's fundamental, which is what
Hmm.
are these companies doing and their ability to grow earnings. It's technical, which is trends and sentiment and shifts in momentum. It's quantitative, right? It's having the ability to scan for ideas, to look for new opportunities, and then that fourth piece is macroeconomic, which is what's happening in the world around us, the conditions in which we're operating. And I would say that that last piece has been a huge question mark for a lot of investors. I don't think it's been that hard all the way up from the April low to now early August to come up with reasons why the market should go lower, right? We can come up with an example of these are the reasons why the market should weakness. It's tariffs, it's companies struggling with inventories and all the pressure about tariffs. It's geopolitical issues, it's military actions. I mean, there's so many things that the Fed, there's innumerable things we can come up with. But at the end of the day, right, the market doesn't really care what you or I think should happen.
Right.
And I've often said that, a former therapist of mine used to call that shooting all over yourself. Like you don't want to say it should happen, right? That's just not a healthy way of thinking about it. You really want to focus on the evidence. So for me, what I still to this day do is every day, every week, focus on the evidence and how it's evolving. So I would say in this particular moment here in early August, we have some things that are still quite strong, which I mean, just the fact that the indexes are in a position of strength, generally speaking, I think is very encouraging. The fact that breadth indicators have gotten weaker, but not too bad yet, is encouraging. But again,
Hmm.
it hasn't have an idea of where that could shift. At the end of the day, things like tariffs, it's very easy to sort of come up with a narrative as to how that could impact the markets. At the end of the day, the markets are all about pricing in optimism or pessimism about what actually is going to happen. And for now, the market's telling you it's still optimistic. So that from a trend follower perspective, which I am at heart, I think it's innocent until proven guilty. You just look for those signs that we're seeing a downside rotation. I don't think we're seeing enough of that yet.
Yeah, I'm kind of the same way. I just don't feel like I'm smart enough to know what the market is going to do. And when you,
Yeah.
kind of pull economists, there's the old saying about how you always get on the other hand. There's more on the other hands than an octopus when you talk to economists. So
Yeah.
I feel like, it's better for me to just look at the technical action sometimes and say, well, this is how the market's reacting to it. Because again, it kind of takes the politics out of it, the economic prognosis. Let
That.
me try to prediction. Right, exactly. Yeah, I almost felt I did a Porky Pig there. So yeah, there's a lot that I just again it seems easier to me sometimes to rely on the technical action than
100%. And
trying to
one,
guess.
if I could
Yeah,
jump in, one
yeah.
of my mentors, Ralph Atkampora, used to
Oh
say,
yeah.
Justin, that you can restate economic data. We saw that just Friday, right? Where the
Hmm.
last 2 months of jobs
Right.
data were revised lower. We can restate fundamentals. So companies often will go back
Hmm.
and I mean, you wish it didn't happen often, but it does, where they go back and restate a previous quarter's earnings. You can't restate price, right? That is where buyers and sellers came together at a particular moment in time. So out of those three, technical analysis, really driven by price
Yeah.
data, is probably the most stable of all in terms of its reflection on what's actually happening. So I
Hmm.
think, again, focusing on the evidence, leaning into charts that continue to work, leaning away from charts that aren't working, that's been a way I've been able to navigate through a lot of different cycles. And I'm not planning on changing that for this
Hmm.
time around.
Well, here's another question, because again, I agree with you in concept on terms of the price mattering the most.
Yeah.
Where I think a lot of people struggle is, there's so much talk on valuation, right? It's like, oh, that's irrational at that price. It shouldn't be at that price. And again, back to your point of shooting all over yourself. There's and sometimes the analyst comments are just crazy, where it's like, oh, we're gonna upgrade this stock to 20 points below where it is right now. Sometimes just very strange things like that like don't make sense. The price
Right.
targets and stuff. how much weight do you put on valuations? Of course, the price earnings ratio is kind of the standard that most people use, but do you
Yeah.
find any value in that?
So here's the thing. I mean, the answer is yes and no.
Hmm.
I will tell you, in certain parts of the business cycle, valuations make a ton of sense. And I've usually found in downtrends, when you're trying to justify buying companies that have been beaten down in price terms, valuations can be very helpful when you actually see, okay, hold on, what am I paying? What when I put my dollar into this stock, what am I getting back in terms of
Hmm.
revenues or earnings or just book value and things like that? That's where I think valuations can be very, very helpful. I think people get into trouble when they lean too much into valuations during an extended bull market phase, because
Hmm.
in every bull market in history, we can complain about high valuations.
Yeah.
And if you look at valuations a couple months ago, we could say they were fairly high, and we've just gone higher from that moment on. So I would say generally thinking about valuations has not served me well in bull markets. That's where I think being more of a trend follower, recognizing that for whatever reason, the market is in a period of accumulation and investors are showing optimism. I think that's good enough for me to follow a trend much higher. And for some of my former colleagues at Fidelity used to say there's plenty of money to be made on the left side of bubbles. Even if you think
Yeah.
AI is a huge bubble right now, there's a lot of alpha. There's a lot of money to be made riding that euphoric wave to the upside. Uh, on the other hand, I mean, I think not much as much valuations, but I think the challenge I have right now, particularly with things like AI, when I hear people talking about the upside potential for Palantir, even CEOs of the company types of people, they talk about extended moves going many many times higher, and giving what I remember very deeply from the late '90s of people talking about valuations and just that this is a new way of valuing company. We need to throw out the old models. This is a new thing, and we're
Things are
valuing
different
companies
now.
based on eyeballs instead of earnings, and that did not
Right.
end well, right? But it rallied quite a bit. But that is what concerns me, and that just tells me to remain vigilant. I don't think you want to become complacent with stocks that have shown a lot of strength. Make sure this is the time when things are great to make sure you have a really good exit strategy laid out way ahead of time. Don't wait for something like Palantir to start selling off before you figure out what you're going to do about it. I would think about that now.
Yeah, no, that's so important because a lot of times, it's so hard sometimes to sell into strength or recognize.
Yeah.
Look, if you've got a stock that's moving up a lot, and I should mention that I do have a position in Palantir myself. If you have a position that's moving up dramatically, you can very quickly have that be an oversized position in your account, which means that your risk profile has changed a little bit. If you started even with a
Yes.
concentrated position at, let's say, 10 or 15%, and it becomes a 25, 30, well, a 5%, hit is different, when you're talking about
Yeah.
10% versus 25%. And
100%.
the emotions just really come to your point, like what you were talking about with Friday. It's hard not to sometimes look at that dollar amount and say, oh
Mm.
my gosh, I lost how much? I mean, that's what I was doing on Friday. It's the old, okay, well, this is not a day I'm going to talk to my wife about, because
Right. Right.
but yeah, certainly that is an issue. And on the fundamental side too, I've got to be honest. Sometimes I feel like even if I knew the headlines ahead of time, I would still
Yeah.
mess it up sometimes.
Yeah. And,
Again,
and and honestly, I think you find that right now with artificial intelligence. You certainly find it in the crypto space and many other spaces as well. The question, I feel like a lot of investors are trying to answer the wrong question. The question isn't, is artificial intelligence going to be a transformative thing for humanity? Like undeniably so. Is blockchain technology going to revolutionize so many things over time? Undoubtable. But does that mean that Bitcoin or Ethereum or Palantir or AMD or one particular company or technology is going to come out winning through that period? Probably not, right? I mean, and it's actually very, very hard to identify now. Even if you have a sense that the technology is going to do so well, it's very hard to identify ahead of time which companies are going to grow, right? And a lot of times, like the early adopters don't end up being the long-term winners. Others kind of come in and take. I mean, look at like Netscape, right? Netscape
right.
completely transformed browser technology
Yeah.
and how we go about our days with laptops, but Netscape's not around anymore and sort of went under because others kind of came up. So I think differentiating those two and remembering really good technology, really good themes, you still have to go through the due diligence and manage your risk effectively. And I think to your point, Justin, I'm concerned about how many individual investors probably have let mega cap growth stocks become basically their portfolio. It's
Yeah.
probably become a much bigger weight. And one thing I've learned working with institutional investors, you are very well trained in how to manage position sizing and making sure that you're trimming on the way up so that a big bet doesn't become your only bet. Individual investors, I found a lot less comfortable with that. So, uh, and I saw that just recently. I still have a decent position in gold ETFs like the GLD and the IAU. Became a huge bet in my portfolio because it just has done so well. I mean, it's outperformed the Nasdaq, not even close in 2025. So I mentioned in a show I was doing, I sold some gold, and someone's like, "Oh, are you getting nervous about gold?" I'm like, I need it's way too big of because I don't want the gold portfolio to be how I retire. It's a bet that's become too large. So thinking about position sizing and the way I would think of it, if you have trouble sleeping at night, your position size is too
Right.
big. Be aware of the weights that you have in your portfolio after the market has had a chance to move.
Well, and I mean, look, I think it's not just individual investors that might be guilty of that a little bit with the Magnificent Seven. A
Mm.
lot of closet indexers out there in terms of the mutual funds. I mean, I think they're kind of in a similar boat. You know, you think about your risk in terms of keeping your job, and who's going to fire you for owning Microsoft or Meta. It's not going to happen, right? No one's going to be like, oh, well,
Yeah.
that was stupid. But you can very quickly, in order to keep up with the market indexes, sometimes you almost have to have larger weights in some of those, at least some of the mutual funds, in order to keep up with performance. So it's yeah, to your point, it's been one of those tricky things. And you know what, maybe this is a good time for us
Yeah.
to shift gears a little bit. And you brought some slides to share with the class, because you're a sharer. And by the way, I was looking at some of the comments that we were getting on YouTube, and people were commenting on how you bring a unique sense of humor, that also is accompanied by great insight. So wanted to make sure that you knew about that. You were getting those
Mm.
comments. But let's talk a little bit about breadth and
Very nice.
some of the market indicators you use. Again, we've got a CMT on here, which someone said is should be certified market talker. Should be the letters. Um, so
That's
right. So,
that's not far off,
right
actually.
now
Yeah,
I'm showing the
that's fair.
McClellan
That's fair.
oscillator. This is something, of course, that was created by Tom McClellan. I think
Yep.
you probably have to. This is probably on the CMT exam. If you can't spell it right, you automatically fail or something like that. But tell me, what is it that the McClellan oscillator is measuring?
So, and a brief funny story. So, Tom McClelland's based here in the Seattle area, and
Oh,
I've
okay.
gotten to know him very well. His parents, Sherman and Marion McClellan, actually created this back in the day. And there was a radio show in Southern California, and I wish I knew what it was, and I would share that part of the story with you. But Tom told me that one time that his parents had created it as a way of measuring short-term breadth, and so it was reported on this weekly show on local radio in Los Angeles, and then eventually, became widely followed through a lot of charting platforms and others that took it on. But the McClellan oscillator is basically looking at breadth data. It's looking at advancers versus decliners every day.
Hmm.
And so it's literally looking at how many stocks are closing up, how many stocks are closing down. And the McClellan oscillator, through some exponential averages and math we don't want to probably spend time on, essentially looks at the slope of the advanced decline data. And so if the McClellan oscillator is above zero, that means the pace of the McClellan of the advanced decline data is improving. And if the oscillator is below zero, it's bearish, telling you in the short term it's weakening. So it's meant to show sort of a short term change, like a rate of change in the breadth data. And if you look from like the second week in July through where we're at now in early August, the McClellan oscillator has been generally lower. So at the
Hmm.
end of June, as the S&P and the Nasdaq are pushing higher into like the 6,300 range on the S&P, the McClellan oscillator quite strong. Breadth is good. A lot of stocks are improving, accelerating off of the April lows. But in the month of July, even though the S&P and the NASDAQ keep going higher, making a new high at the end of July, the breadth data starts to rotate lower. And so what that implies is that for every Palantir, just kind of continuing on like everything's great, there are a lot of other stocks that we're not thinking about that are starting to rotate and be in more of a position of weakness. And we've seen that certainly, in day-to-day breadth data where the decliners have outnumbered advancers in a number of the major averages on the average day here for the last couple weeks. So I would say as long as this indicator remains below zero, it basically implies there's a weakening of breadth, that even though some leading names are still doing well, and even that's enough to keep the major averages fairly elevated, there's a lot of weakness underneath the hood. And that's where breadth indicators can be so valuable. A lot of times we can get lulled into a false sense of security based on just analysis of the S&P or the NASDAQ. And breadth data helps us sort of look one layer down and think about the fact that the S&P 500 is made of 500 some individual companies that might be doing something very, very different. So short-term breadth indicators have started to weaken here. And that is one of the things that just has me taking on a little more of a cautious tone here as we go into August.
No, that totally makes sense. And one of the things that I'll look at sometimes is, and this has been really interesting, how it's kind of played out. You sometimes look at SPY versus RSP, and I mean there were these times like right in here where the S&P 500 wasn't having a great day, and RSP was having a great day, and it was like, oh, okay, well, it's the Magnificent Seven that that's not doing well today, and everything else is fine. And then, to your point, right there, as you were saying, RSP has been, for the last couple weeks, really coming down, as you pointed out, mid-July. And I mean, you kind of saw that with the Russell 2000 as well. The Russell 2000 was starting. I mean, there have been so many times where I thought the Russell was going to break out, and it's Lucy with the football at this point, getting ready to pull it out. So I think I probably tried one more time here, and I don't think I got it in at the peak, but maybe I was 3 points away on a $2,200 index. So do you kind of use some of those gauges as well, or we can flip over to some of the models that you've created?
For sure. I mean, to this point, there are a number of ways you can think about breadth. There's a number of ways you can think about leadership. And I would say looking at the cap-weighted S&P, which is, I mean, incredibly top-heavy, and it's become even more top-heavy in recent years. And I haven't looked at the numbers in a while, but I mean, the top 10 names in the S&P 500 are probably the same weight as the bottom 380 to 400 names would be my guess.
Yeah.
It's mind-boggling how much of a weight Meta and Microsoft and Nvidia and those stocks tend to have. So regularly reviewing the equal-weighted S&P, looking at the mid-cap index, looking at the small-cap index, and just seeing how they relate to one another will tell you a lot about leadership and how much the mega-cap names could be skewing our perspective. If you think of the market as the S&P 500, you're really not understanding the dynamics of a lot of the individual names that again, a lot of times can look dramatically different. So we're seeing a lot more weakness the smaller you go in down the cap tiers, as we would say.
No, I get you. I'm going to go ahead and switch over back to our presentation, and again, the slides that you shared, which I should say that were from stockcharts.com. You were formerly the chief market strategist there. The market trend model. This is your own little baby. What did you? You don't have to share the math and there either, but what you do here?
Yeah, so this really speaks to the idea of multiple time frame analysis. I find a lot of times, and it's not just individual investors, I found advisors and arguably even some institutional investors, you get so trapped into a particular time frame, right? Kind of like the main time frame you're paying attention to, and then you ignore some of the evidence or some of the signals that can help you understand kind of the forest for the trees and what's happening around you. So, a long time ago, I realized I'm a position trader generally. So I'm usually looking about 1 to 3 months out on average, right? And that can change depending on whether something's working a long time or whether something reverses in the short term. But generally, that's about where I'm trying to look out. So I really started with using the weekly chart of the S&P 500 and just thinking about what is the trend on that time frame that I'm operating on. And I realized that was what is now shown as the medium-term model there. But I also realized that that trend is part of a much longer shift, right? Sort of that secular shift that you'll see in the markets where themes and ideas come in and out of favor. And so that longer term time frame, or the secular time frame, is shown in purple here, basically showing the strength or weakness of that long-term trend. And then I also have to remember that the time frame I'm operating on is also made up of a lot of little, peaks and valleys, squiggles in the market, flickering ticks, and I call that the short-term model. So the way that I design this is using weekly S&P 500 data every Friday after the close. I look at a series of exponential moving averages, which is just a really good way of analyzing trends and weighting them more heavily to the most recent data. So it's pretty sensitive when the market would start to shift. And at any moment, I have kind of a quick cheat sheet on what the trend is on different time frames. So the long-term time frame, by my definition, turned bullish back in March of 2023, coming off of the 2022 low. For the last couple of years, it's been pretty bullish, and that's shown on the chart we're seeing here, where the purple histogram is above the zero line. But basically, the long-term secular trend, basically a couple months after the October 22 low, turned bullish. That makes sense to me in terms of the long-term trend. The medium-term model, though, was bullish.
And just real quickly, I think it's a little interesting that as bad as April was, probably because you were using weekly data, it actually stayed bullish there. So barely above zero, but it did.
And it's great because I designed this years ago. It's always interesting to battle test it yet again. So as things start to sell off, I'm thinking, all right, is it, what sort of signals are we going to see? But it did. It remained bullish, and what that reinforced to me, when the long-term model remains bullish and the medium-term and short-term turn bearish, that tells me, okay, this is a cyclical pullback, and we're probably setting up for a pretty decent buying opportunity. And I just want to be thinking about protecting on the way down and just looking for signs of a rotation higher, which ended up being a pretty decent way to play the April low for sure. So the medium-term model was bullish all the way through the end of February of this year, and after the top that we had in February with the S&P and the Nasdaq making new highs, medium-term model turned negative, which tells me to go kind of risk off to get more defensive. And then beginning of May of this year, that medium-term model turned back bullish. And that suggested to me, all right, that low that we had a couple weeks ago, that was the low. And now I need to start going more risk on. So from like early May to where we're at now, it tells me to be more, taking on risk in the portfolio, looking for opportunities. And then the short-term model actually just went below zero on Friday of last week. After that jobs day that you mentioned, it was enough of a drop to turn the short-term model negative. And given what we're seeing today and so far this week, right, we're recording this on Wednesday the 6th, for now, if this was the end of the week, the short-term model would turn back bullish. So for now, it's telling me this looks like a short-term pullback within a cyclical uptrend. And until that model changes, that just tells me to be patient, not to get too scared. And this is one of the ways, by the way, that I try to manage the emotion that you mentioned earlier. It's easy to get really panicked when there's that initial drop on a Friday of last week. Using a model like this consistently every week the same way has helped me to put things into perspective and understand the trends I'm really trying to play. And for now, still okay.
Yeah. And it's kind of like, I think of this too when I'm sometimes using the intraday charts something looks horrible, right? And then I take that step back to the weekly and it's like, oh, this is a blip. This is nothing. What was I sweating, type thing.
Yeah.
Is there any element of this that, that you're looking at and saying, oh, there is an extension here. Like it's extended. It's maybe gone on for too long. Anything like that kind of says, because a lot of people were getting concerned. Oh, are we long in the tooth? We've been trending above the 21-day moving average line for 65 days, whatever, without touching it. Are there ever any time frames or extensions that you're looking at in that regards?
So there's definitely an element to that in the technical analysis toolkit for sure. Not something that I use as part of this model. This is meant to be pure trend following. For me, this model is meant for me to think as little as possible, because what I found was before I started using this, it was all subjective. I would look at a daily chart, a weekly chart, a monthly chart of the S&P, and I would start kind of drawing all these conclusions. I was like, you know what? I just need to simplify and have one chart that just tells me here are the trends, and just make sure that I start with that as an initial assessment of the markets. Having said that, when we're in like an extended rally, to your comment, the market can become very overextended. And from a technical perspective, that means something like we're going really far away from a key moving average, like we're X
Right.
percent above the 200-day moving average. And when that happens, that often means mean reversion is kind of coming in. So I think of that as more of like the tactical play, right? The tactical time frame. This trend following model helps me just recognize the trends I generally want to be participating in. More of a tactical model like that would tell me, all right, is today the day when I want to take a new position? And if we're super overextended, if we're, kind of leaning too far over our skis, I guess is a good
Yeah.
analogy, then maybe you wait a little bit, right? You hold and wait for some sort of pullback, and it's a more actionable opportunity. So perfect scenario for me is long and strong charts that have pulled back in the short term. So going back, I mean, some of the best buying opportunities that I saw, like in 2024, were when the long-term and medium-term models remained bullish and the short-term model turned bearish. Those often ended up being some really good secondary entry points on the way up. So that's something I'm keeping in mind right now, because if that's how this plays out, this is another buyable pullback among many off of the 2022 low.
Yeah, there was definitely that period in time of like roughly around May, I feel like, where there was some
Yeah.
sideways action last year, and
Yep.
then it was kind of off to the races for a bit. And one other thing, just on this model, I guess everyone kind of has to find the time frame that's right for them.
Yeah.
When you have the longer term time frame, yeah, that means that you're probably looking at larger drawdowns. Shorter
Yeah.
term time frame, you're going to get shaken out more, but you're also, not going to participate in those big long moves. So how do you kind of balance that out? Is that why you have all three, to kind of
Yeah,
help you
no,
gauge?
100%. And the way I thought about it, Justin, when I was designing this, was I started with the medium term time frame, which for me is really where I'm trying to operate. Like that's the time frame I'm generally trying to get right. So I started there, and then I thought, all right, what's the longer time frame that's going to help me put that into proper context? And then what's the shorter time frame that's going to help me understand what's actually happening day to day during that creates the trend that I'm trying to play on. So if I'm more of a swing trader, I probably have a different model I would be using, and I'd
Right.
be thinking of that swing trading time frame as my main time frame. Then I would be looking a little shorter term and a little longer term. The idea is not to look at whatever question you're trying to answer as an investor. Don't make that be the only time frame that you're thinking about. Recognize that, when in doubt, zoom out. If it's unclear, you bring in more data. If you also want to get more granular and you're trying to make sense of short-term noise, you zoom in a little bit. And so I think thinking of that and thinking of multiple timeframes, a little longer, a little shorter relative to what you're trying to do, is a real good starting point for most investors.
Yeah, absolutely. And it's so, I don't know. There's almost that beauty that you see in nature with fractal patterns that you
Yeah,
see in
yeah,
charts, right? There's a beauty to it where you kind of look at something and it's like, oh, this pattern, if you zoom out, there's that pattern still, that you can kind of see.
yeah.
One more chart here that you were kind enough to share is the
Mm,
bullish percent index. So if you could
yeah.
explain this real quick, what is it that you're looking at here?
Yeah, so point and figure charts are a classic charting methodology. You mentioned like Tom Dorsey, who's one of the legends in the technical analysis community, and really popularized point and figure analysis with a lot of investors. This indicator came from a gentleman named Abe Cohen, who back in the day, was the first really to start popularizing point and figure charting and had a service to talk about his results. And he created a series of breadth indicators called bullish percent indexes. And what we do with the S&P 500, with the NASDAQ, and a bunch of other, sort of groups of stocks, is you literally look at all 100 NASDAQ 100 names, which is what we're doing in this particular example, and looking at every one of the point and figure charts. And it's doing this obviously automatically at this point, but you basically say what percent of those are currently showing a bullish conclusion using the classic point and figure methodology. And if you're not familiar with point and figure charting, I mean, you're basically charting trends going up and trends going down. And
Mm,
what's important is when a stock is in an extended uptrend, it actually takes quite a bit for a sell signal to emerge. It actually takes quite a bit of a reversal. It's not just one day sort of thing. It's a big rotation lower. So the bullish percent index being very high is encouraging. And we saw in mid-May that indicator was up to around 85%, which means 85% of the NASDAQ 100 names were in a bullish point and figure profile, which is remarkably strong. It's one of the highest readings that you'll see. But then what's happened in the couple months since, into June, July, and now August, is that bullish percent index has gone lower and lower. And as of today's close, it's actually down below 50%, around 47%. So what that means is about 40% of the NASDAQ 100 names have generated a sell signal on their charts just since mid-May. So even though the NASDAQ composite has broken out, even though the S&P has made new all-time highs, less and less of this large cap universe of growth stocks, less and less of those are participating in the uptrend. And it lines up pretty well with things like the McClellan oscillator that are showing a little more weakness. This tells you that, again, Palantir feels a little more like the outlier right now, just being in a nice, slow and steady uptrend that appears like it's onward and ever upward. There are a lot of other technology names, like an AMD comes to mind, that are maybe not looking as ideal anymore and starting to pull back a little bit. And the thing is, if you go back in market history, you will find that that is a characteristic of major tops, that you will find a lot of breadth conditions rotate lower. As some of those early rotators start to come down, there's enough big names still doing well that the indexes remain strong, but it can often be sort of an initial red flag. So this particular indicator getting below 50% this week, I would say is arguably one of the more negative pieces of evidence that I'm seeing right now in my toolkit. And again, just tells me to be cautious going into August and September, arguably the weakest part of the calendar, seasonally speaking.
Yeah, no, it's so important because I'm guilty of this myself. Just as you said, sometimes looking at that zoom out of other time frames, sometimes you can have your portfolio seems like it's great, like, oh, I'm getting all this outperformance. It's because I'm so smart and I'm just a great stock picker. And you're not recognizing that there's kind of this, there's something bubbling under under the surface, like some bad B movie, monster that's going to come out and, really rear its ugly head. So to kind of put a bow on this, so you shared three different, kind of breadth indicators with us. And so, how do you use this? So it kind of tells you maybe a little bit of what environment you're in, and maybe an extra level of caution. But do you ever say, oh, wow, this has turned, I need to start reducing exposure, or I need to start hedging? How do you use it in practical application?
So, no, it's a great question, Justin. I would say, and to the point you just made, I was taught, don't confuse brains with the bull market, right? When things are going up, it's very easy to get very confident that you're a rock star investor, a rock star stock picker. You got it all right. But the reality is a lot of bad habits can emerge, and you can get away with a lot of bad habits in a bull market, right? When things are working, you can get away with having a sloppy process and not having good risk management because it doesn't really hurt you. But that's why I think in this sort of environment, that's what you want when you make sure your risk controls are really good and that you have a great stop losses already articulated and you have a good exit strategy, because when the market turns lower, a lot of times it can be way too late to really get ahead of that. Mm-hmm. And to that point, I think that's what these breadth indicators kind of do. I would say the technical analysis toolkit can generally be separated into two buckets. You have leading indicators, things that are meant to help you anticipate a turn, things that are helping you identify the market might be overextended, like we talked about, moving away from a moving average. Signs that there may be some internal weakness, which is what a lot of breadth indicators do. Maybe that, even though the indexes look pretty good, that there's some other things breaking down that I might not have known if I hadn't looked at those breadth indicators. So I would say a lot of those leading indicators are starting to fire. Bearish divergences, right? Like a Nike is making new highs, breaking above a 200-day moving average in the last month, but on weaker momentum, right? A measure of price momentum is actually trending lower. So, a stock moving higher on weaker momentum, on weaker volume, those are things that would tell me, okay, maybe I want to question the sustainability of this uptrend. Those are all leading indicators, and the market can go higher in that environment, but it tells me to look for the lagging indicators to start to fire. And that's where you think about, okay, what's the line in the sand on the S&P 500? What would I see on the chart of the S&P 500 that would tell me, okay, that uptrend is no longer working, and we're starting to show some real real weakness? what sort of leadership rotation would you see? Things like utilities or REITs starting to really thrive. Those would be more kind of lagging indicators that, okay, investors are really
Well, I
starting
don't
to
know
get
about utilities
defensive.
anmaybe utilities kind of
I was gonna say maybe that's an old,
we're
maybe I
doing
need to
their own thing.
update that sentence. Hold
Yes,
on.
exactly. Yeah,
Utilities are the next growth thing. I forgot, right? Yeah.
exactly.
Yeah.
Yeah,
Huge growth
just because of
area.
the AI adjacent
Yeah. That's
aspect
right.
to them.
Okay. Yeah. Okay. We'll go with REITs and consumer staples. Okay.
Yeah,
We'll go with
consumer staples. I
beverages
think
and things like that.
you're
There we
safe
go.
there.
Okay. Fair enough.
Tobacco, right?
Yeah. I mean, so those sorts of, right, higher yielding, higher
Mhm.
income kind of plays. I mean, those would be things that tend to happen kind of mid-turn or sort of as things are rotating and as investors start to really get defensive, things start to change. So for me, my process is an exercise in balancing some of those leading indicators, and those are things that I'm seeing now versus lagging indicators, things that are more confirmational, things that tell you, okay, now I need to be out because there's enough deterioration that I really want to protect myself from further downside.
Mhm. And I love, one of the things when you were talking about the leading and lagging indicators when we were
Yeah.
having our discussion on Monday, I want you to use your crystal ball and windsock analogy because
Oh yeah, yeah.
I absolutely love that. So if you could just share that.
Yeah, no. So I mean, so many people, and I see this a lot because I've spent much of my career trying to educate investors, money managers, institutional investors down to individual investors on how to use technical analysis and how to, manage their portfolio with a good awareness of market conditions using charts. And I found particularly early on, a lot of people think of technical analysis like a crystal ball, right? Our
Yeah.
goal is to predict the future, and this is when I get questions like, "Where's the S&P going to be at the end of the year?" I mean, no one knows. I mean, I can't tell you how much no one has any idea. It is an exercise in a total guess to
Yeah.
to make that sort of projection. But I don't think that's the game. That's not the game we're playing. That shouldn't be the question we're trying to answer. Technical analysis should be more of a windsock, and that's something that technical analyst Carl Swendlin, who's actually a fellow Southern Californian, shared with me years ago. Thinking of it as a windsock, if you think about it like a pilot, if you've ever tried to land an airplane, a windsock still to this day is at most airports, and it just shows you the direction of the wind at the runway, but it's really giving you a tendency of what's happening. There can be wind gusts, there can be surprise changes in direction, and I can't tell you how many times I've tried to come down in a training flight, and then your experience right at the runway is very different than the windsock told you even 2 minutes ago, just because things shift around. So you're taught to pay attention to the windsock, pay attention to the expected market direction or the expected direction of the wind, but always be making these little subtle corrections with the yoke, with your controls, and then with your portfolio as well, right? Being just recognizing that even if you had an idea of what's going to happen, your actual experience in the heat of the moment could be very different. So you have to be ready to adapt to changing conditions, and that's where I find a lot of investors get into trouble. They're still kind of investing with like the previous cycle's strategy, or they
Mhm.
have their eyes so focused on this crystal ball that they forget to just open their eyes and recognize when things evolve. You have to have your all of your senses ready to bring to bear as an investor.
Yeah, like the old rock weather vein, how is it raining? The rock is wet, type thing. You know, and look, to your point, Bill O'Neill, the founder of Investors Business Daily, loved talking to pilots because of that.
Yeah.
Situational awareness is a big thing. Of course,
Yes.
that's where your Sierra Alpha comes
Yep.
from on your Sierra Alpha research, and yeah, and certainly risk management is at a different level of impact as a pilot because of the uh, what happens when you don't properly do risk management when you're flying in a plane. Let's talk a little bit about some stocks because I want to make sure we get to
Yeah.
some of those. And you were talking a little bit about the whole idea of sector rotation, and
Yeah.
maybe one to kind of share. I mean, Motorola. Yeah, I mean this. If I'm not mistaken, this was back in the 90s, kind of a darling, or as cell phones were coming on. Was this
Yeah.
one the Razor back then?
Yeah.
It
That's
was the
right.
Razor phone, if I
Yeah.
remember correctly. So
Yeah.
Motorola. I mean, this has been below the 200-day moving average line for most of this rally. So
Yes.
what looks intriguing here to you?
Yeah, so I mean, I think as much as we're seeing some of the leaders, and not to just keep throwing Palantir as an example, because there are others as well, but you've got sort of this mega cap growth rate still working very well, and a lot of technology still obviously looks quite strong. But what I'm noticing are a number of stocks that have been struggling, that have been underperforming, maybe didn't participate as well in the rally off of the April lows, actually starting to see a bit of a resurgence here going into
Hmm.
August. A number of healthcare names kind of fit into that bucket, things like biotech, right, starting to improve. And I think Motorola is one of those kind of bucket of names as well. Back in the day, this
I'd maybe
great
put the home builders in there too that just got
home
above the
for sure.
200-day
I mean,
moving average line.
all of
Yeah.
those charts you just showed you, the home builder ETF, the
Hmm.
biotech ETF, Motorola, all that same sort of thing, right? They were sort of underwhelming off of the April low, kind of stalled out and more sideways, but now all of a sudden started to rotate higher a little bit. A number of these are starting to regain their 200-day moving average after being below for so long. And one of the things that I used to do on boy Market Smith, I feel like back in the day, this is on my iPad on the ferry in Boston. I
Now
would run a
market
scan
surge.
of yeah, now market search. I would run a scan every day of stocks making new 3-month highs and new
Uh-huh.
3-month lows. And it was the only product I had that I could reliably do on my iPad every morning to just flip through charts on the way into the office. So I had some ideas of names to talk about with the portfolio managers I was working with. And still to this day, that's a scan that I run every week. And so Motorola came up on that scan earlier in July as it broke above the swing high from sort of the 4th of July weekend and then back from May as well. Now it's sort of pushed higher and it's pushed up to the 200-day moving average, which is where it stalled out back in April a couple times and then into early May. So we have a stock that's been more range bound. We're starting to see improvements in terms of the short-term strength. We're seeing improvements in relative strength because it's starting to improve while other things are starting to struggle. I think for this one, it's probably a little too early for me to be jumping into a chart like this, but this is where I set an alert and say if Motorola can get above 445, 450 and sort of finally push above the 200-day moving average and get out of this range that it's been in, that to me demonstrates a stock sort of going into an accumulation phase with plenty of further upside potential. And this is a name that, there's no way you could describe this as an overextended name because it's been languishing more in a consolidation period for a number of months now. So
Yeah.
stocks just emerging from bases like that are where I see some opportunities. And if for me, if you've been, in winning growth names and they've become too big in your portfolio, these are the kind of things I would think to rotate into because they're improving charts.
And to your point, we have our relative strength line versus the S&P 500. That
Yep.
has certainly seen a nice uptick lately. Now, earnings tomorrow after the close. How do you handle earnings coming up? Like you get a setup, and earnings are within a few days. What do you do?
Earnings are one of those really annoying but wonderful things about investing in individual stocks. It's arguably the best and the worst things about individual names because you have that earnings risk, right? And earnings are usually a binary outcome
Right.
where you could have a big spike higher, a big spike lower. With something like this, given the fact that earnings are coming up this week, that's why I think it's an actionable chart. I would love to see if we get a positive earnings result that pushes the stock above the 200-day. I would probably take a position. Given the fact that it's still not breaking out, I probably wouldn't be too aggressive going into earnings. I'd usually wait to see how things play out. So what I do love about Market Surge is how it shows within the chart, classic O'Neill style. It has the information kind of right on the chart, and having an awareness. Talk about situational awareness, recognizing that earnings are coming in, and just recognizing that could be a huge catalyst to the upside or the downside. Definitely something you want to be aware of. But that would probably cause me to be patient and wait to see how that plays out.
Yeah, totally makes sense. On the financial side, American Express, this has come down right to the 200-day moving average line. Again, a lot of things were maybe getting support at the 21-day or 50-day lines on Friday, kind of
Yeah.
getting a bounce. A very different look in terms of where it closed in its range, kind of that
Yes.
upside reversal look.
Yeah.
But support right there at the 200-day moving average line.
So if you're a candlestick aficionado out there, it's a hammer candle, which is a classic kind of bottoming pattern where the open and close are near the highs of the day. And you can see that on a bar chart easily as well. We're sort of right at the, close at the highs of the day. So think about what that means. During the day, we traded below the 200-day moving average, but someone somewhere was buying in enough to push the price back up to close near the highs of the day. And that's why a lot of technical analysts would consider that a pretty decent short-term accumulation sign, telling you that this sentiment is indicating the buyers are coming in at the 200-day moving average. So I would say the chart of AXP, this is where I would probably draw a trend line off of the highs in July now into early August. We can see the price pattern in the short term, lower highs, lower lows. So I would get excited when that pattern breaks, which means we break above the trend line. That would be something I would get really excited about. The fact that we, held the 200-day with that, sort of bullish short-term pattern tells me that's pretty encouraging. I would probably think of an entry point more when we're able to, break out of that pattern to the upside. But that's where I would say, names like this that have pulled back, if they can find stability and start to rotate higher, that's pretty encouraging.
Mm-hmm. And I like that how you're, again, not projecting or anticipating. You're saying, okay, I'm prepared,
Yeah.
for it to do this. If this happens, then I can act. But you're not saying, oh, I think this will happen, so I'm just going to try and get in 50 cents lower, and you're actually waiting for the trigger
Yeah.
instead of trying to
And
jump
and
in
what
front.
you're describing, Justin, it's sort of hope, right? I hope this
Yes,
happens. And
right.
hope, as we know, is a four-letter word for investors, right? So I think of this as think of it as an if-then statement. If this happens, then I do this other thing. And this is the type of chart where you lay it out ahead of time. You set the trade up ahead of time, then you just wait for the trigger, which
Yeah.
validates it and causes you to take action.
And if it never happens, then that's information too, and it saves you
Move
from a
on.
lot of trouble,
That's right. That's
getting
right.
into something you shouldn't. Last stock, real quick. Tesla. Look, this is probably one of the stocks that I made the biggest percentage gain on
Yeah.
in my career. Just in my trading career, just from some of these moves that it had back here in 2019. But
Yeah.
I have a Tesla Model Y. I love it. It's great. I don't get to drive it much. My wife takes it all the time. Um, but this just hasn't done anything for me to, warrant me getting in. And on the valuation side, you have people that are saying either this is $1,000 stock or this is a $50 stock. There's kind of like nothing in between. So what do you do with
Yeah.
something? What do you do with a chart like this, especially since it's always in the news? It seems like.
So it is a very news-driven name. Obviously, a lot of controversy around the founder, who tends to be in the news often as well. And this is where I full disclosure, I have a Tesla Model 3, which I love. It's a fun car. I mean, it's just fun to drive. But I think where we get into trouble is thinking that good technology. I mean, it's great technology with a good car wrapped around it is the way I think of the experience. But whether that means the stock is a good buy today is a different question we want to ask. For me, right, if you think about Motorola kind of potentially sort of breaking out to the upside, you think of something like an American Express, which has had a clear pullback to support. Tesla's kind of going that third direction. It's going clearly sideways. This is called a consolidation phase, or what we call a narrowing of the range. We have lower highs and higher lows, creating what we call a coil pattern or a symmetrical triangle pattern. This basically says the market's telling you the stock's worth about $320 a share, and we're just kind of overshooting and undershooting that equilibrium price, right? That's kind of what the market is telling you. The moving averages are like a spaghetti chart. It's kind of all flat right in the middle. So there's no real dimension, no real momentum at work. I would say this is a buyers and sellers in balance, in very good balance. So the good news about this chart, and you mentioned John Bollinger, you're going to be talking to him soon. These are the types of charts that John would always share with me, which are, names consolidating. So the volatility's coming in. And these are great charts because you just wait for that move. You wait for the breakout after that low volatility period. So I think we're in a consolidation phase. I don't know based on this chart yet which way we're going to break, but I have a clear signal as to what would tell me this is a positive breakout, and an equally clear signal what would tell me this is a negative breakout. And thinking of that coil pattern and which way it resolves is most important. Now, John Murphy, who's one of my mentors, would say that a pattern like that usually resolves itself about 2/3 to 3/4 of the way through, which should be right about this week or next week if you look at the shape of the pattern. So we're right at the point where we probably get a directional move in Tesla. And that's why I think something like this and just laying clear levels ahead of time, I think following this next move momentum-wise will be the right play on the stock.
Yeah, that is great analysis, David, and I think a great place to end things. Really appreciate you coming on. Again, I love your analogies. I love your education. For folks that aren't aware, you have your own podcast that is absolutely great. You just had Mike Webster, our very own Mike Webster, on not too long ago, but great information on there. And of course, people can follow you on X as well. What is your handle at DKeller CMT? Is that
That's exactly right. Yeah.
okay? I was going off memory there. I should have checked my notes, but yeah. Oh, look, there it is. I checked my notes. So, David, thank you so much for being on again, sharing your knowledge and everything you do for investors. I really appreciate it.
No, good to be with you, Justin. I hope we have IBD's Justin Nielsen on my podcast here very, very soon. I would look forward to that
Let's do it.
conversation as well.
Oh,
But
that'll
in the
be fun.
meantime, no, thanks so much. And thanks to Mike and the team. You guys are awesome.
Okay. Okay. We'll talk to you soon, David.
All right.
That's going to wrap it up for us this week. Thank you so much for watching. And as David mentioned, John Bollinger is going to be on the show next week. He is, of course, the originator of Bollinger Bands. So talk about your technical action. We're going to learn from one of the masters of a very widely used technical indicator. So hope you join us for that. Thank you so much for watching. We'll see you next week. Take care.